So it's always good to get a perspective from around the world. Edison's been in the US market now for over a decade, and I'm really pleased to have the current pairing talk to us today. What really struck me about them was in their recent podcast, just how they articulated the power of compounding and high returns and the impact that has on the portfolio. Really pleased to have Mark Fischer and Mark Rayner from Royce Investment Partners here today. Let's hear what they have to say.
Welcome everyone to the second edition of Vantage. I'm really pleased to have this pairing on. This is the first time many listeners may have heard of Royce. Would you like to tell us a little bit more of what Royce is all about?
Sure, Neil. Absolutely. So I'm based in the UK, but Royce is a New York-based investment management firm. Where the other Mark sits. We're an active fund manager. We run about $16 billion of money for our clients. The focus of the strategies is either a quality focus or a valuation focus. Interesting, the firm was set up in 1972 by Mr. Chuck Royce, and Chuck is still our chairman. 50 years later, he's still our chairman. And he's still a lead portfolio manager on a lot of our important strategies. And really, Chuck is considered, one of the founding fathers of small cap investing. I mean, 1972 predates the Russell 2000. It predates really small cap as a specific asset class. So he's really one of the, right at the sort of, the frontier of this this type of investing. What else to say about Royce? We remain very focused on small cap. I think of the asset managers that Morningstar rates, of those with assets under management of over 5 billion, we are the only company with more than 95% of that greater than 5 billion in small cap. We remain a very small cap focused firm. We have portfolio managers which are very experienced. I think the average tenure is over 20 years. As an average for our portfolio managers. I think probably the final thing to say of importance is that we are owned since last year by Franklin Templeton. So we are part of the Franklin Templeton group. We operate independently on a day-to-day basis. We're a specialist investment manager within the Franklin Templeton group, but they are our majority shareholders, and clearly for lots of business reasons, that's a very powerful and good parent company to have.
That's great. And let me pick up on that sort of focus on small cap. Clearly, an asset class has actually done really well over the last year or so. Why is this asset class something that investors should pay attention to?
We think that international small caps perhaps are one of the last inefficient frontiers when it comes to public markets investing. We believe that there's structural and a significant opportunity in international small caps, and also that it's one that's often overlooked. Why? First, the international small cap universe is vast. Our universe consists of more than 10,000 companies. And if you look at the MSCI ACWI ex-USA index, then for every constituent in the large cap version of that index, there are roughly 4 constituents in the small cap equivalent. So this is really a vast universe. But secondly, it's also highly inefficient. Because the universe is so vast, it's very difficult for the sell side to completely cover it, especially seeing how sell side resources are constrained. And that results in relatively poor coverage. For example, we estimate that approximately 30% of the companies in the small cap index that I just referenced have 0 coverage or just one analyst covering them. So, and I guess just looking at my experience too, if you look at markets like Japan, for example, it's not uncommon at all to see $1 billion companies with no coverage at all. So that lack of coverage then also by extension results in relatively fewer large, sophisticated institutional investors participating in the space. And lastly, I would also say it's incredibly diverse. So sure, the small cap space has plenty of rubbish, but it also has plenty of gems, businesses that are world leaders operating in really attractive niche sectors. So don't let anybody tell you that quality is large cap. So in the end, really, it's this combination of a large, a really inefficient and a diverse asset class that we think creates a perfect environment for stock pickers like ourselves.
And I'd like the audience to get to know the both of you a little bit better. So I'm and I'm hoping that the answer to this is that you started investing your paper money around in stocks when you were 11 years old. But tell us a little bit more about your backgrounds, how you came into the fund management space, and what's drawn you to this asset class.
I can't promise I've been investing my paper round money, Neil, but interestingly, since being a late teenager, I've just been interested. I have this curiosity of why some businesses and some industries are more profitable than others. I always just found that intriguing. So I always thought that I would do something in business, something in finance. So at university, I had a degree in economics. Can't say I loved that. I left university and then I trained as a chartered accountant. Can't say I loved that either. But in 1990, I had a very fortuitous call from a recruiter, and she was looking for a small cap analyst to join a US investment bank. She wanted a newly qualified accountant who spoke some German, and I'd also studied that at university. And when I read the job profile, I thought, this is it. This is what I want to do. Mm. And honestly, 30 years later, I haven't for 1 second ever doubted that this wasn't the right career. I never wanted to do anything else. And the reason is, it is just endlessly fascinating. If you operate in the world of smaller companies, generally you're looking at companies which make one or two products. So they're relatively simple business models, So you can analyze them. And then secondly, who do you get to meet at the company? Where you get to meet the founder or the CEO or the CFO. Yep. So you get to know people who know these businesses backwards, and people who are the key decision makers. So again, you can analyze these businesses, and you can answer that question, which I started with. Why is this company more profitable than the other? You don't always get it right, but it's endlessly fascinating, and you're always climbing up learning curves. Looking at smaller companies.
That's great, Mark.
I would probably trace my interest in things international all the way back to my early childhood. I wasn't investing a portfolio when I was 5 years old. But I remember growing up in a German city called Düsseldorf, and I went to an international school there. And I can still remember my first day of kindergarten and how terrified I was that I wouldn't fit in. And I couldn't have been more wrong in the end. I think I fit in quite well. And in hindsight, thinking about it, I think it had to do with the diversity of the community and the fact that they welcomed people from all sorts of different backgrounds. So then later, as I was thinking about what careers to pursue, it occurred to me that no matter where I end up professionally, I want it to be somewhere where I can build on my international background. What got me into small caps actually relates a little bit to what we discussed earlier, and that's that there are so many companies out there that in some way or another affect what we do every single day, but whose stories will go untold. And so take something as basic as a bowl of cereal, for example. Many of us have it for breakfast, we take it for granted, but it actually takes quite a rich ecosystem of suppliers to get that bowl onto your table. You have the farmers who supply the grain, you have manufacturers of automated production lines and sorting technology with advanced sensors. You have companies that employ chemists and lab coats who engineer the perfect flavor. You have product consultants and marketing specialists, you have producers of folding carton. The list goes on. So maybe it was just curiosity, but I loved the idea of getting under the hood of these companies, understanding what they do, how they fit into the ecosystem, and then ultimately investing in them.
Okay, and Mark, when you were talking about what brought you into the small cap, you talked about the quality. I mean, you call yourself quality investors. What does that actually mean?
Yeah, it's a good question, because in the small cap area, I would say the vast majority of small cap investors would either call themselves a value investor or a growth investor. Broadly, I don't know, 10% of value investors, 90% are growth investors. Now that's fine. I mean, a value investor likes to pay a low multiple of something, profits or assets. A growth investor likes to buy a company which is growing its profits or its revenues. That's fine. We like to do that as well. We like to buy companies on reasonable, better multiples. We like to buy companies which are growing. So in that sense, we're a value and growth investor as well. But we think that value and growth investing is missing something. If you want to be a buy and hold long run investor, it's missing something. And what it's missing is the fact that over the long run, share prices, we believe, are driven by value creation. They're driven by the value that a company creates. Prices are driven by value creation. Now, there's an iron law, it's mathematics, it's non-debatable. The companies that create shareholder value are those with high and sustainably high returns on invested capital. So if you want to be a buy and hold investor, you have to have as your starting point return on invested capital. And that's our definition of quality, it's return on invested capital. You could call us a return on invested capital investor if you like, but that's, we call it quality. We call it quality at a reasonable price. So the starting point has to be return on invested capital. Once you've done all your analysis on the sustainability of that return on invested capital over the long run, then you can look at the value of the stock, the multiple it's on, then you can look at the growth. But the starting point has to be return on invested capital. And if you can find that company with high returns on invested capital that's going to stay there for the long term on a decent multiple which is growing, those are the compounders. And that's what we want to do. We want to invest in the value compounders. Compounding is what Einstein calls the eighth wonder of the world. We want to invest in that, and that's what we're all about. We're trying to find companies and buy them and stick with them for long term. Enjoy this power of compounding, and that's what quality investing is all about.
I mean, it's one of the reasons I wanted to talk to you, because I listened to your last podcast, and that really struck out for me, that a company with 40% return on capital growing at 8%, you can just work out just how powerfully that sort of grows your money. So, okay, well, how do you find these companies? I guess there's a huge universe, and there's two of you. How do you comb through the sort of 10,000 companies and sort of find effectively what we describe as those sort of gems, the needle and the haystack companies?
Yeah, you can't comb through them on an individual basis. There are just too many companies. There are too many companies. The world is too complex. There's too much to know. And Mark and I are very much the view, we don't want to try and play the role of being the cleverest person in the room. We're going to make too many mistakes. We have a circle of competence, and we want to stick within that circle of competence. So what does that mean? We're very much of the view is, stay humble, put all your thinking into a process, and have a process of exclusion. And that process should help you identify those companies with the highest probability of sustaining high returns on invested capital, and relentlessly follow that process. So that's what we do. And we often say, the process is our fourth, fifth, sixth, seventh, eighth colleague, because it is a process of exclusion. So that's what we do. All our thinking is in a process, and that process really focuses us down on the sort of companies that we like. Now, it's worth saying that, and we often talk about something we call false negatives, because it's a process of exclusion. There will be some great companies that we don't invest in, and that's fine. We don't want false positives. We don't want to buy, or we want to limit to as much as possible. We don't want to buy companies which we shouldn't. We want to keep the mistakes the absolute minimum. So we set the dial of risk very high. We want to exclude a lot of companies. Built a process, and we follow it. We follow it relentlessly. I would say.
Yeah, I mean, look, I mean, every manager I will talk to is typically going to be following a process. Could I sort of dig into a little bit deeper and says that, you know, what makes your process a little bit more unique?
Yeah, no, absolutely. And, you know, we love our process, to be honest, and we do think it is somewhat differentiated. Firstly, the starting point. So we screen, but we don't screen for value, we don't screen for growth, we screen for return on invested capital. So that in its own differentiates us. And we set a hurdle. We want a 5-year mean of at least 20% return on invested capital. So here we're starting the process of exclusion. So out go heavily cyclical companies, out go blue sky companies, loss-making companies, out go utility companies. You know, they don't have a return on invested capital. So that's the first thing. Second thing, and this is something very much from Chuck Royce, we think good companies, quality companies, should have good balance sheets. If they don't, they're probably not as good as we think, or if they don't, where's the money gone? Their capital allocation is wrong. So that's the other thing we screen for. We like equity in the balance sheet rather than debt. So we want at least 30%, of the balance sheet to be equity. So again, process of exclusion. Outgo heavily indebted companies, outgo banks. We don't buy banks because, you know, that model is based on gearing. It's based on a geared ROE. We don't want that. So then we have a pile of companies which follow high return on invested capital, strong balance sheets. What do we do? The temptation would be just to wade in there, and, you know, as we were discussing earlier, and try to analyze all of those. And again, we'd make too many mistakes. And this is the second thing, important part of our process. There's this great book written, you know, 30 years ago by Michael Porter, Competitive Analysis, 5 Forces. It's a great book, you know, and it's influenced, you know, so many people in this industry. But we think there's one force which is more important than the others, and that's the customer. The customer that decides. So let's understand that relationship. So the next thing we do is we ask, or we perform what we call the customer test. And we ask ourselves 3 questions. So we screen for ROIC, we screen for balance sheet. Then for all the companies left, we ask the customer test. It's got to pass 3 questions. Firstly, what's the customer benefit? We need to be able to understand that. Again, keep us within our circle of competence. So out goes biotech companies. You know, we don't understand biotech, so, you know, that will exclude it. We don't understand the customer benefit. The second thing is we want companies where their customers have no ability or incentive to be price aggressive. And we have a lot of things that we look at in terms of, you know, making sure that those companies have a lot of questions that we ask. But out go, for example, a lot of auto suppliers. If you sell to Volkswagen, Volkswagen will beat you up for price. They're professional buyers. They buy, you know, price is heavily part, you know, of their buying decision, and we don't want that. And the third question we ask is we want businesses where the customers have no ability or incentive to leave. We want really sticky customer relationships. So outgo, for example, retailers and almost all B2C models. You know, which supermarket you go to is, you know, you can decide on the day. There's no necessarily enduring relationship there. And we have 7 tests. We have, and the customer relationship has to have one of those 7 tests. And we expressly look for one of those. For example, subscription businesses with high renewal rates, that would pass our test because it's a sticky customer relationship. So then we can do most of this on the desktop, to be honest, Neil. You know, you can do the customer test often on the desktop.
Yeah.
Again, process of exclusion. And then the companies that are left, we do something called enterprise quality scoring, which is very detailed, very granular set of questions under 5 different pillars, each are equal weighted, lots of different questions, and we score our companies out of 100. And in order to get into our database, you've got to score at least 70. If you don't, you're out. We note in our system why you failed, but you're not in our database. And it's only those companies which have screened for return on invested capital, have strong balance sheet, passed the customer test, and scored higher than 70 in the EQS, then go in our database and eligible for investment in our strategies. So that's our process. No ifs, no buts. it has to follow that process. And again, linking that back to, we do generate a lot of false negatives, and we know that, but we don't mind, because we don't want to generate false positives. We want to keep mistakes to the minimum. So that's what we do, and we follow that.
That's great. I mean, I think that what you sort of set out is that a set of parameters where, if you imagine a cycle, those companies with strong balance sheet, strong pricing power over their sort of client base, they will endure cycles, etc. So if you're buying high quality businesses, I can see how those returns compound over time with less risk. A lot of our we've been through an extraordinary last sort of 18, 24 months since the outbreak of COVID. It's been a roller coaster. You've had huge influences from both, political sort of step-ins, etc., central banks acting, and a spray of sort of constant news flow and changing behaviors. A lot of our listeners are going to be asking themselves how to effectively make sense of this and how to take advantage of it. What would your advice to them be?
It's been extraordinary indeed, Neil. And as hard as this probably is to follow, our advice would be not to be swept away by the hype, really to remain laser focused on companies that create shareholder value. And so we believe, as Mark mentioned, that the best way to generate a good return long term is by investing in value creation and not by speculating on share prices, which is what we're seeing happening at the moment quite frequently. So for us, this means we don't want to spend our time trying to find the next promising theme, because sure, companies that offer work from home technologies or that have crypto in their business descriptions, or that might be benefiting from rising interest rates, those companies may or may not have their time in the limelight. But unless they produce high and consistent returns on invested capital, they may not be good long-term investments. So for us, taking advantage really of the current market doesn't mean finding an emerging theme, but what it means is investing in the same, which can often be quite boring, value compounders, but that, as you mentioned, Neil, have these enduring qualities and business characteristics, but at a time when the market has decided to temporarily ignore those. So we think really patience and discipline in this asset class really tends to pay off. And that does mean that sometimes when the market is chasing fads or thematics, that quality stocks underperform in the short term. But in the long term, we've found that markets always return back to mathematics and value creation.
That's great. Could you provide examples of two of such quality companies that you think might be ignored or that you otherwise find attractive?
Sure. Neil, the example that I would give is a German company called Newark. And Newark is considered the LinkedIn of the German-speaking countries of Europe, so Germany, Austria, Switzerland. And in fact, it's even bigger than LinkedIn is in those countries, with over 20 million members in its network. So like LinkedIn, its tools help individuals build the career network and access job opportunities. But importantly, around 80% of the company's profits actually come from businesses who are paying Newark recurring fees for recruiting tools that they use to hire talent from Newark's network. And this is key because in Germany, like in many places these days, there's an acute labor shortage. And in fact, the company estimates that about 1.5 million unfilled job vacancies exist in Germany. That's a number that will triple in the next decade as the population ages and the population declines. And so we think that Newark is in the pole position to take advantage of that structural opportunity. Why? Well, as the largest network, it can more easily attract employers who are willing to pay for its recruiting tools. And that really large number of employers then in turn attracts more and more job seekers to the platform, creating a sort of virtuous circle or network effect, if you will. And yet less than 10% of companies that could be using its tools currently do. And we think that that really creates plenty of runway to build on its success. So why has the company then been ignored? This is a company that traditionally was considered a growth company. So from 2015 to 2019, it grew its sales by 20% a year. And then COVID happened and the company still grew, but growth understandably slowed down as businesses were reevaluating their shorter term hiring needs. And so, for example, this year to date, the company grew its revenues by mid-single digits so far. Now that's really unnerved the growth investors who are focusing on this temporary slowdown and less so on the company's strong balance sheet with no debt, or on the company's consistently high returns on invested capital, which are driven by a really asset-light model and more than 30% EBITDA margins. So really long-term, we think that COVID actually creates an even bigger opportunity for Newark because the resulting grand resignation that is occurring makes finding talent even harder and more critical for businesses. And so Newark, I think, is an example of a company where a disciplined focus on long-term value creation will be rewarded.
You earlier said that you don't avoid fads, avoid themes, etc. And you don't necessarily invest in themes. What about this broad topic of sustainability and environmental awareness? Just seeing the sort of finish of COP26. With so much talk about sort of rising energy prices and the risk to climate, is that something that you focus on or take into account?
Absolutely, Neil. But the way that we do it is that we set our sights really on the long term. We're very long-term investors, so we look for companies that we think benefit from really long-term structural trends, which includes, among others, the climate change trend and the need for greater energy efficiency. But we don't play the current theme of rising oil prices. Doing that, you can think that you're smart and it's fun to try to take advantage of rising oil prices, but these prices are cyclical and we avoid cyclicality. So I'll give you an example of one company that we think benefits from this climate change trend, and that's an Italian company called Corel. And so Corel, what they do is they make components and software that are used in cooling equipment, like, for example, refrigerators and air conditioners. And those components and software make this equipment more energy efficient. So it turns out that buildings are actually responsible for some 40% of global energy use, and air conditioners are a key culprit. So effectively, what Corel is doing is they're providing the brains that make cooling equipment work smarter. And so effectively, that then reduces energy consumption by up to 50%. But importantly, just going back to our core investment philosophy, this focus that Mark described earlier on high and consistent returns on invested capital, what that also means is that we're less likely to invest in companies that contribute negatively to climate change. Why is that? Because to achieve a high return on invested capital, you need either high margins or high capital turns or both. Or in other words, you really need to find an asset-light businesses. That's what we prefer, asset-light businesses. And so by extension, then topics like greenhouse gas emissions, like air quality, tend to be less financially material to those businesses. We've also, though, developed more of a systematic ESG playbook that we use to integrate ESG into our investment decision-making, and then also engage with our companies on important ESG topics. So we're constantly looking for ways to incorporate best practices in the area of ESG.
Thank you, Mark. That's great. That's a great answer, and I really like this idea of low capital intensity is naturally bringing you into businesses with less of an impact on climate. So one to think about when you're screening for companies. One of the things we are seeing right now is inflation accelerate globally. What's your view on this, and how does this impact your strategy?
Well, Neil, we have no view on inflation. We're not top-down asset allocators. We're stock pickers. As we've said a lot on this discussion. We're stock pickers. I would say a couple of things though. Firstly, that the stock market or investors have over the last few quarters been investing in some sort of, I would say, thematic inflation hedges. And by that I mean areas like banks have been doing very well, really in sort of anticipation of increasing interest rates. Energy companies have been doing well. Obviously, price of oil is strong, as Mark was saying. Gas, etc. So energy companies have done well, and raw material type companies have done well. Companies that dig things out of the ground. Now, it's probably no great surprise that we don't buy those sort of companies. Those are not the sort of companies that we like. So we haven't taken part in that sort of thematic rally, if you like. But what can we say about the strategy and how generally we're positioned for inflation? Now, again, we don't overtly position for inflation, but we do think the strategy is well positioned as a happy byproduct of the process. Because if you remember, what sort of companies do we invest in? It goes back to the customer test. We look for companies, and this is exclusively what we look for, companies where the customers have no incentive or ability, or little incentive or ability, to be price aggressive, and also companies where their customers have little ability or incentive to leave. And what does that mean? That means that we buy companies with pricing power. We buy companies with pricing power. I mean, that goes right through the strategy. And if you have pricing power, that means you have a decent chance of passing any cost increases that you have over to your customers. Maybe not straight away, maybe the next quarter or the next half, but generally the principle is there within the strategy as a happy byproduct of the process that we think the companies are well positioned for inflation.
That's great. Listen, I think you've given us a really good overview of how you both think about picking ideas, the process, some great examples in that. I particularly, I wanted to sort of wrap up just on the human nature sort of type question. I like the fact that as asset managers, there's got to be a natural curiosity. It really came through when we were talking about your backgrounds. I wanted to leave the audience with this one question, and you can both answer. You've been doing it for a while. What's the one thing that's surprised you, or one unusual fact that you've really sort of learned through this process?
Maybe I'll kick off behind as well. Going back to what I was saying earlier, you're constantly learning interesting things. I mean, you're sitting in with founders, CEOs of a whole different range of different businesses. So you're constantly learning different things. One thing, I don't know if this is directly answering your question, Neil, but one thing that surprised me on day one and carries on surprising me is how inefficient the smaller companies market is. And this was something that Mark was mentioning earlier. Mm-hmm. And by that I mean, a company reports news flow, and I would sit here and think, well, I expect the market to react in a certain way, and it doesn't. It wasn't in the share price, or was in the share price. There's this thing called the efficient market hypothesis that people learn about in business school, that share prices always have all known information incorporated into them. Therefore, you can't generate alpha. Therefore, you can't beat the stock market. Give up. Invest passively. Whoever came up with that theory has never spent a day in smaller companies. It is such an inefficient asset class, and you constantly learn that. You relearn that almost every day. I'll give you one example. It's a very old one, but it sticks in my mind. Way back in August 1996, I told you this was an old example. Porsche was about to launch the Boxster. Very eagerly awaited and anticipated. Everyone's seen the designs, and there's a big clamor. Mm-hmm. Porsche is going to bring the Boxster. And I was on the sales side of the industry now, working for an investment bank. And one of my colleagues said to me, Mark, we should be recommending our clients to buy Porsche. This was in the very month that they were going to be launching it. And I said, come on, everyone knows that. It's in the share price. That can't be right. Well, the stock price trebled over the next year. It wasn't in the price. It wasn't in the price. That's why I remember that example from 25 years ago. You never know what's in the price or not. The market is really inefficient. And that's the great thing. That's one of the interesting things about smaller companies investing. It's an inefficient market. The market can be beaten. If you want to invest in small caps, you do, and not, this isn't the marketing thing, you do it with an active manager because you can beat the market. The market can be beaten because it's inefficient.
And Mark Fischer, is there anything you want to add from your side of the pond?
For me, probably one of the things that I learned in my career is the importance of remembering that in the end, this is a people's business. You know, there's so much talk in our industry about performance and assets under management. But actually what's happening is that there are clients, people who are entrusting us with their money. And then we as a team work together to try to make the best possible decisions on behalf of those people by investing in companies that ultimately are comprised of people who want to make a living for themselves and their stakeholders. And when we deal with people, our approach really matters. So how do we treat our clients? How do we treat our team? And how do we treat the businesses that we invest in? In the end, respect, kindness, and empathy, these are things that are non-negotiables. So of course, making money is important, but the way that we seek to do so is equally important.
That is, and let me just say that of all the asset managers, Mark, you're one of the nicest that I've dealt with. So it's a very appropriate wrap up. Mark Rayner, Mark Fischer, it's been an enormous pleasure for me to talk to you. I think I've learned an enormous amount about Royce. I look forward to staying in touch, and people, please do check out Royce and the work that these two guys are doing.